Now, it is a condition where supply equals demand for a specific good. So this is very, very important for all of us to understand for a moment. The value of the marginal product of labor, it's very important. Why? Because at the minimum cost, when you are able to derive maximum value, so I would always say is this factor is something like this: QS is equal to QD, that is quantity supplied is equal to quantity demanded. Good morning and welcome to the revision class in 2nd PUC Economics, where we are going to talk about Chapter 5, Market Equilibrium. This is a very, very important chapter, so please pay attention, where you're going to learn about the concepts of market equilibrium. Now let's go to the agenda today, the chapter introduction, of course, followed by the weightage, the question types and question and answers. So let's just go on to the weightage of marks that we're going to talk about. We are going to have the 1 mark question 3. So that's going to be for 3 marks here coming up. And then followed by 1 2-mark question. So that's 3 plus 2, 5. And a 6 marks question. So that is going to make the total to 11 marks. Just you can see that one chapter and you will be able to score 11 marks coming out here. So this is going to be really wonderful. So this chapter is all about the market equilibrium. So what is this market equilibrium? Why is it so important? Now, it is a condition where supply equals demand for a specific good. So this is very, very important for all of us to understand for a moment. Now, supply meeting demand, that means you are coming to a neutral stand altogether. Now, there are many times we would always see in a general market that supply and demand are never met, because if they are met, then that's a perfect condition that we are talking about. So that's exactly what is making us understand at this particular junction when the supply is trying to meet the demand at a given point. Followed by, there is no tendency for the prices to move while the market is in equilibrium. So this is very important for us. Prices will not move once the supply and the demand are met at a particular point. Now, at that point, you will see that neither the price rises nor it decreases. So what is happening is that the price becomes stagnant here, and so we attain a position called as price equilibrium. Followed by a competitive market. Suppose I'm going to talk about a market which is not just going to have the supply and demand curve meeting at each other, then probably that would be the most competitive market that I'm going to talk about. And in that market, what is going to happen is that the competitive market would balance the market cost if the amount provided, that is the quantity supplied, raises to the amount that has been requested or the quantity demanded. In a normal market, what we are trying to talk about is a situation where supply and demand will try to overcome each other so that the price comes to a fixed point. Now, what normally happens in a regular market, what people fail to understand is that there is an automatic equalizer which will be set into the market where the supply and demand will try to meet at a particular point. So whenever I say the supply curve and the demand curve, this is the demand curve that we are talking about and this is the supply curve, there would be a position where they would tend to equate themselves automatically, and thereby the market will try to balance. So that's exactly what we are talking about in terms of the market conditions. Followed by, let's get on to the chapter summary, where we're going to talk about the equilibrium excess demand, where the demand is more than the supply, followed by excess supply, which is quite evident enough. The supply is more than the demand factor. Marginal revenue product of labor. We all know that labor is something where we're going to talk about the extra work that we are going to get for the same amount of cost factor. The value of the marginal product of labor, it's very important. Why? Because at the minimum cost, when you are able to derive maximum value. Price ceiling, which is a very important question. Why? Because this is the maximum price that is fixed by the government, beyond which the firms will not be able to set the price of a product. And price floor, the reverse of it, that is the minimum price that has been set by the government. So you will not be able to sell a product below that price. followed by perfect market competition, as we were talking about it, the supply and demand curve meeting each other, and it's a point at which the price remains stagnant and we don't see any kind of movements altogether, followed by the demand and supply curve shifts, which are very, very important that we are talking about. It depends on the values here. Free entry and exit of firms, that is very, very important. Why? Because if the movement of the firms are going to happen, that means we would see that in a perfect market, anytime a person can come into the market and can exit out of the market at his own will and wish. So that is going to be a very big factor that we are talking about in terms of the market condition. Now, why this free entry and exit comes in a perfect market is that in a normal market, suppose I want to set up a shop, I want to enter into a market and I want to run a business of my own. It is not that easy. Why? Because there is competition, there is cost involved, and there are other parameters which will block me from entering the market. But in a perfect market, we believe that at any point of time, you can walk into the market and you can exit out of the market at zero cost. This is probably only a theoretical assumption, but in practical walk of life, this is not going to be possible at all. Now, followed by, let's go to the exam corner with the 1-marker questions that are coming in. Define market equilibrium, a situation where the good supply meets the demand. So I would always say is this factor is something like this: QS is equal to QD. That is, quantity supplied is equal to quantity demanded. When you are able to meet this condition, we call it as market equilibrium. When the market is in equilibrium, there is no tendency for the prices to change. This is very, very important for all of us to know. Why? Because once the market is fixed, the market has come to its position altogether, then there will be no change in the prices absolutely. Followed by, what is an equilibrium price that we are talking about? This is the price where only the desires of the consumer and desires of the producers agree. So what I typically mean by an equilibrium price is that the position where the producer and the consumer come to an agreement point and saying that this would be the agreeable price. This is the price which we both of us would agree to pay and receive. So that's exactly an equilibrium price altogether. What is meant by price ceiling? The price that is the maximum price that is set by the government for a product, that is called as price ceiling. And price floor, the minimum price. This is the key word I want you to keep in mind. When I talk about ceiling, it is maximum price. When I talk about price floor, that's the minimum price that has been set by the government. Followed by the equilibrium price and quantity. Now, when we talk about the 2-mark question, the same question can be repeated. Now, that's what I want to give you a piece of advice here, that whenever we are talking about economics, it's quite possible that there would be questions which would be repeated with an extension of marks. No need to worry about it. All you need to do is that write the correct answer and you will be able to score the entire 2 marks for this question. So what we're going to talk about, we're going to talk about equilibrium price and quantity. So it's a mixture of 2 questions. You would have seen this question as a 1-marker separately, but now you're seeing it as a combination. So here you will be seeing equilibrium price and quantity. We know what is the price factor, where the quantity of goods supplied and demand matters, and the point at which the demand and market supply meet, that's the intersect point. That's where we are talking about the quantity factor also. So in a 2 markers, the one thing that you have to remember is that please try to answer the question completely. What normally happens is that people continue with the same tendency of writing the 1 marker. You would have just finished the section A trying to answer all the 1 marker by just putting in a word or a line. But when it comes to a 2 marker, it's not the same. You might have to extend and write a couple of lines more. So it is mandatory for you that you spend some time trying to understand and answer the question completely. Please do not take it like the 1 marker just where you just write 1 word or you just finish it easily. Please take the time, look into the question. Have they asked multiple questions? Have they asked single question? Take some time, you will be able to score the 2 marks. Followed by marginal revenue product of labor. This is a very important thing what we are talking about. The additional amount of revenue a firm can generate by hiring additional employee. Now, there are many situations in organizations today where the company believes that I can make an additional revenue by running one more shift. So let's say there is a manufacturing firm and the manufacturing firm is producing 1,000 units per day. But then I believe that from tomorrow, if I can increase the production to 1,500 units more, I will be able to make better revenue. So in order to manufacture 500 units extra, you would require extra labor. Now, that extra labor will come at a cost. It's not going to be free, but that extra labor will also generate an additional revenue to you. That's exactly what we are talking about, marginal revenue product of labor. By employing one additional labor, the additional revenue that gets generated due to that employment, we are talking about marginal revenue product of labor. So this is very, very important, and it is found by multiplying the marginal product to the labor by the price of the output. So you know that moment you are increasing the output by 500 for every unit, you are going to make some X amount as profit. So that's how we are going to find out the marginal revenue product of labor. Followed by, how is the wage determined in the labor market? Now, this is a very, very wonderful question that is always asked by students or any one of us for that matter, to find out how exactly the wage factor is determined. Now, many people think that wage is something that is given for granted or taken for granted kind of a thing, but then it is not that kind when it comes to economics. Wage is determined by the intersection of supply and demand. So this works out everywhere in economics. So what happens is that when the supply of labor increases and the equilibrium price falls and the demand for labor also increases, then automatically the equilibrium price rises. Let me make it very simple. If there are too many people available in the market to do a particular job, automatically the wage rate for that job would come down. Why? Because there is a supply of labor available from every corner of the city. But on the other hand, to do that same piece of job, if there are very few people available, that means the quantity of supply starts decreasing, or the demand for that job starts going the other way when you start looking into it, vice versa, then automatically what happens? The labor rate goes up. Now, for example, in a town, there is only one plumber available and there is a huge demand for plumber. So automatically the wage rate of that plumber would keep on increasing because he knows that the demand for his skill or for his work is going to be on the higher scale. So automatically his wages would keep on increasing as he starts completing the task. But if there are too many plumbers available in that city, that means the wage rate would become normal or a very, very moderate, because there are too many people with the same set of the skill set available who will be able to complete the task. Followed by, what is the implication of a free entry and exit? Now, this is a 4-mark question that we are talking about. So when the number of firms are in a perfectly competitive market, then we are talking about the firms are operating in a short-run position. That means to say that the equilibrium price is determined by the intersection of demand and supply. So what does that implicate altogether? Now, in a short run, we allow the people to come in and go out. So there is always a possibility that they just come in, they barge in, they take up the factors and they do go up. Of course, as I've told you beginning, what happens is that there are some times when a 4 markers will also become a 6 marks. A 6 marks can also be taken to a 4 mark. So this is one question where I find that you need to understand the implication. So that's why when you look into this particular question, you will be able to understand that every market will have a short-run supply where there will be too many firms, and there will be a time when too many firms exist, which gives an opportunity for the other firms to come inside, and the business continues in that cycle altogether. So what we mean here is that automatically the market levels itself trying to understand the supply and demand factor. followed by, let's go to a POQ kind of a question. It's not exactly a project oriented question. This could also come in a normal type, but then this is a very, very simple question that has been asked. Let's try to solve it. We all know that QD is equal to QS. So let's equate it. 200 minus P is equal to 120 plus P. So bring the P's together to this side. So it will become, let's say 200 minus 120 is equal to 2p. So this is 80. 200 minus 120 is 80, which is equal to 2p. Hence 2p is equal to 180, which is now let's say that P is equal to 80 divided by 2, which is equal to 40. So if you're just able to solve this much, automatically you are going to get your 4 marks. Such a simple problem. All you have to do, put the numbers to one side and the variables on the other side, equate it, and you will get the answer. With this, we come to the end of the revision for Chapter 5, Market Equilibrium. I hope and believe that all the questions and the answers discussed through this session will be of great use to you, both in terms of practicals, also in terms of the theory. Now, all I want you to do is that please focus, pay attention, try to solve the questions one by one, try to read it carefully so that you will be able to score full marks in your exam. In the upcoming session, we are going to talk about Chapter 6. That's going to be the non-competitive markets. Until then, stay tuned, stay blessed, and stay enlightened forever. Thank you once again for joining me today on this wonderful session.